The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and thank you for joining us for today's webinar on changing faces of GST compliances and GST audit. Today's webinar is hosted by Nexdigm and USISPF and focuses on new GST compliances, understanding the amendments in GST audit forms, and key takeaways for companies. Joining the discussion today are Jigar Doshi, Executive Director, Indirect Tax, and Rebecca Pinto, Senior Manager, Indirect Tax. Both the speakers have extensive experience in GST. Before we begin, kindly note that all our listeners are in listen-only mode. If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address your queries at the end of the webinar. We are happy to host today's webinar for all our listeners. Without any further delay, we shall start the webinar. Over to you, Jigar.
Thank you. So, very good afternoon, rather very good evening to all of you, and thank you for joining us. Uh, Before we start the webinar, there are two things that I would like to initiate. One, uh, why are you all here online and listening to something which is on GST compliances? Is basically the thought process that you and your company would like to be compliant. And to be compliant, it is important for us to understand what is coming our way. So the reason why this 1 hour of investment would be required from your side would be to listen to us to understand what's coming your way. We have tried to capture, as can be seen from the slide of the index, that what are the key important things on the compliances from GST front, which is upcoming, and what is it that you need to know is what we have captured. Basically, the new compliance process where we have already, learned the way of doing compliances today, and we are now going to unlearn whatever we have learned and go into a new zone altogether. We are then going to talk about e-invoicing, and then we will touch base on the annual returns and GST audit, which is the recent changes which happened on it, for you all to understand that how simplification is coming also our way. Um, the first and foremost thing, whilst you are listening, we are on almost 893 days down on the compliances on the GST law. And, almost if I round it off, it's 899 days that we are talking about. So today we all are very much habituated to file the returns the way they are, GSTR 1 and 3B. In fact, most of us have forgotten that 3B was a return which was a summary return and a stopgap arrangement that government has created to ensure that summary data is provided to the government. These were the not real intent of the government. The real intent of the government was from day one when the law was made to have the data of purchases and sales, which is GSTR 1 and 2, in a very robust manner. And if you remember the good old days in 2016 and 17, before the GST law started off, we all have attended demos of various service providers, of software service providers, where the intent was to claim the credit, was to modify the invoices, was to amend, was to lock, was to freeze the numbers, etc. So all those thought processes were already there as an intent of the law, but it never had the time to see the reality because of the fact of various compliances coming into picture and entire India as an economy coming together. Now what we are seeing is again that intent getting covered into the reality, and this time the government is pretty geared up to see the change happening. So whatever has been learned today till today is going to get into the unlearning process, and new processes will be required to be set up. Why it is important to know this is because you will have to change your mechanism of getting the data, of your ERPs, of your people doing your compliances, of your consultants doing your compliances, and you'll have to be geared up with the continuous monitoring of compliances vis-a-vis the due dates that we handle of 10th and 20th currently. So when we talk about the slides in upcoming in the time, you will realize that it's a continuous process that we are entering into. This slide very basically helps us to understand what is government thinking and how government is thinking on this front. Is whilst the compliances are changing, they are looking at a scenario wherein basis the turnover limits, only 7% of the assessees will get covered into monthly returns. Majority, which is 70%, will get captured into the quarterly filing of returns. Very important distinguishing factor is, while it is a way of telling this information, there is also a very silent way of updating, by the government, is whilst you will be filing quarterly returns, which is a 70% of the economy will file quarterly returns, the payments will have to be done monthly. So probably filing of returns will go quarterly, but calculations and all the data collation will have to be done on a realistic basis, online, on a real-time basis. So the time will come when we will realize, whilst we are on the 70% of the bracket, most of us, the computations will be done required on a monthly basis. One slide also on a broad level basis of what is good to know about the upcoming compliances is most of the fields are going to be auto-populated. This is what a data is felt. Obviously, there could be some fields which would be amendment would be required, but at least most of it would be auto-populated. If we go back, say, almost 15 years, we would remember the days when TDS compliances was a big task, and even computing incomes was a big activity for individuals. Now 26AS form in income tax is very clearly a document which comes as a base, and there is no uh, hassles to be thought through in filing a routine income of statement by the assessees. Similarly, here what we can assume is, while the time is very fresh, in times to come, 80% of the field is going to be auto-populated. So your returns will get started to get auto-populated from the government, and probably in 3 to 5 years' time, we will again see the ray of light wherein most of the things will be auto-populated, because the information will be there with the government at a very base level, which also will be discussed in future. The real-time ITC reconciliation is where my colleague Rebecca would be talking to you and explaining how it is going to happen. While it is why it is to cheer is basically it will not be a post-mortem exercise. It will be there at the right time. So even if you want to held back your vendor payments because ITC or credits are being restricted, you will be able to do that, on a real-time basis. On something to not cheer about is, the impact on the working capital, because the credit will be restricted. It will not be on provisional basis the way currently it is. A new system will have to be learned by all the people who are involved in doing their compliances, and also the way we said, the payment will be done on a monthly basis. So these are the broad level good news and bad news for this. Uh, this one slide will also explain you how it is changing the scenarios. If we see the process when GST law got introduced, we are saying it's a past process. Current is where 2019 where we are working, and future is where in 2020 we will enter. It was earlier on a self-claim basis. It was no restriction on the credit that you are claiming, and a reconciliation was required on a complete basis. After the year is also over, you are getting time to do the reconciliation. Current scenario, very recently the law got amended where the restriction of credit was there. An SSE is not able to claim the credit more than 20% of the eligible credit vis-a-vis the unreconciled numbers. So there is a restriction now. It cannot be claimed in complete sense. And in future, if we see, it is going to be auto-populated and real-time reconciliation would be required to be done. Uh, with this, probably I will give it to Rebecca to talk about the overview of the compliances, and then once it is done, we will also talk to you on what all companies are required to be doing on getting ready on the upcoming compliances, and then we'll talk about the invoicing and audit returns.
Thank you, Jigar, for the quick overview of how the new compliances are going to look for companies. I would be deep diving into the returns and the new filings that are required to be done by the companies. I'll start with a quote that Barack Obama said once, and I think I can relate to it now that I'm speaking on new compliance processes. He started to say that issues are never simple. One thing he was proud was that very rarely will you hear him clarify or simplify any issues. And likewise, I'm faced with the same position today where I'm going to discuss the issues and the impact of new compliance, but I'm not sure whether I'll end up simplifying that for you or not. Nonetheless, let's try to together understand what new compliances have for us in future. First and foremost, we need to understand that the new compliance system has bifurcated taxpayers into two categories. One which they refer to as large taxpayers and one which they refer to as small taxpayers. Now, large taxpayers are those which would be having a turnover of more than 5 crores, and small taxpayers up to 5 crores. How will you decide whether you have a 5 crore turnover that qualifies as a large taxpayer or no? Is you run through the definition of aggregate turnover under the GST law. Now, the definition of aggregate turnover has very well been discussed since July 2017, because we as consultants or we as companies who are filing tax returns had to constantly see which turnover limit are we breaching. First, when it came to migration, second, when it came to registration, third, when it came to annual returns and audit. So, time and again, this turnover definition has been discussed. This is something that we are again going to be discussing when we decide the new compliances applicable to us. Basis our category that we fall under or a taxpayer falls under, he will be filing returns, or the periodicity of his returns would be decided. Now, aggregate turnover, for your reference, is appearing on your screen right now. It says 5 basic elements you need to consider your pan India turnover. That means when you're deciding the periodicity of your returns, if you are 5 crores, crossing 5 crores of a turnover in a financial year across all your registrations in India, you will fall under the large taxpayer category. While it excludes RCM or reverse charge payments, it does include exempt supplies. So specifically for those into exempt supply industry, we'll have to include that calculation in the turnover. Also, another thing is that while your financials will depict a turnover number which will not include inter-branch transactions, the aggregate turnover does include something known as deemed supplies, or supplies that are interstate between the same person having the same PAN number. So again, your cross charge and your stock transfer numbers will be included when you calculate the PAN India turnover. And lastly, the fifth element is it will be calculated for a financial year as a whole rather than a particular month or a particular period. Moving on to, we'll discuss these return formats also in two categories. One for the large taxpayers, how would the return process look like, and the next for the small taxpayers. Now, for large taxpayers, and this slide will help you relate to your old returns as well. What we are talking about is 3 forms. One is GST Annex 1, second is GST Annex 2, and third is GST RET 1. This nomenclature you will have to remember throughout the slide deck. Why is it so? Is because RET 1 is the only return that an assessee is required to file. The other two forms, that is Annex 1 and Annex 2, is something that you will upload as a data on. These are simple formats that are available on the GST portal. These are not something that you will be filing but uploading, and the final DSC attachment and payment of taxes will go through your GST RET 1. That is the reason you will see the GSTN and the CBIC telling you that in the future you're going to be filing only one return as compared to 2 or 3 that you are working on right now. How would you relate to your old return forms? Annex 1 is nothing but similar to your GSTR 1. Annex 2 is similar to GSTR 2, which is on your inward or purchases. And Annex or RET 3 is something that is similar to your GSTR 3(3)B. If you want to relate to it as a business person or as a finance person, you will need to understand that it's nothing but Annex 1 will require sales, RCM and import data. Annex 2 will require purchases for ITC. And lastly, RET 1 is a summary for GST payments. If I have to put a perspective to how your compliance scenario will change for large taxpayers, let's take an illustrative month of January. Say this system goes live on January 2020. In January, on a real-time basis, I can now start uploading my sales invoices. Between 31st of Jan and 9th of February, I will have to finalize my sales. The reason being is any sales that will be uploaded after 10th of February will not be available for taking credit towards your customer or your recipient. So your recipient will not be able, while he may able to view the invoice, he may not be allowed or entitled to take credit of any invoices that you upload after 10th of February. So hence your work as a taxpayer starts that between 31st and 9th of February, you start working on all your sales and finalization. In the interim, while you're finalizing your sales between 31st of January and 9th of February, you set a cutoff date, say 5th of February. Now, this is a cutoff date that is subjective to every company. We have taken it as 5th of February for this illustration just to simplify things and put in perspective the actions that are involved. Why would I take a cutoff of 5th February to match my purchase invoices? Under the new return system, while you can view invoices on a real-time basis that you are going to put in, as a supplier is going to put in, you also need to understand that your invoices will be viewed by your customer. Now, between 5th and 10th of February, when you're finalizing your sales, if your customer comes back to you, or you can go back to your vendor and tell them that there are particular invoices that you need them to add, which have not been disclosed in their GST system as on date, and this will help you take credit after 10th of February. This will help you save a lot of cash flow because now the system is going to be real-time reconciliation. So between 5th and 10th of February, you will also be working on securing your cash flow position qua your vendors as well as your customer relationships when it comes to uploading those invoices. So this brings us to step 4, where 5th to 10th February, I will communicate to at least my major vendors, and I may also conversely receive communication from my customers. Moving on to 10th of February, I come on to the date of 10th of February where the government has set a cutoff for me to upload sales invoices. I finish or conclude the liability. On 10th of February, whatever invoices have been uploaded by me will be accounted for as my sales liability by the GST system. While I will be allowed to upload invoices even after 10th of February, the system cuts its date off on 10th, so the liability or my tax payment will be determined on the last invoice that I've uploaded on 10th of February. After 10th of February, my work is purely on the purchase side or the input tax credit side, where I will decide what kind of invoices do I want to accept, reject, or put on hold. When I say accept, that means I accept that this particular sales has happened to me and I would want to avail credit on them. When I say pending, that means I know that I'm entitled to take this particular credit of invoice, but this credit is not occurred or accrued to me as on date. These are instances where your goods have not been received as on date, but you've already received a tax invoice via email, or maybe the services have not been received by you. So, where you've not completed the conditions under section 16 is where you can evaluate you want to put a particular invoice on pending or not. And reject is that action where those invoices you do not want to avail or there is an incorrect detail that is provided by the supplier in your name. So you may send that invoice back by rejecting it to the supplier to correct and send the correct, upload the correct details. Once I have done this, what is my time period to cut off my input tax credit availment? Now the cutoff is 17th Feb 2020. Why? Because the Annex 1 system does not allow me to upload invoices between 18th to 20th. While the law has a date of 13th and 15th of February or 15 days in the subsequent month, while the GSTN portal is saying you can upload on a real-time basis, by the system or by the schema organized by this new return system, automatically we are set at a date of 17 because between 18th to 20th I'm not allowed to upload invoices to say that I may not be allowed to access system or take action on the Annex 2 front. So we will have to evaluate it, we will have to come to a live scenario to see how this input tax credit freezes. As on date basis, whatever data is available and joint reading of the rules and instructions, you can assume that 17th February should be a cutoff for you to finalize your Annex 2 input tax credit availment. When I have finalized this, by 20th of February is my due date to file my RET1, and pay my taxes to the government. So this is how an overall tax team will be functioning if in the month of January the new system goes live. What does compliance system for small taxpayers look like now? Small taxpayers have four options. The first option is you file RET1, Annex 1 and Annex 2 like standard as applicable to your large taxpayers. Now, one thing you need to note is if you are an exporter, if you are an e-commerce provider, you will by default fall under this option 1 or the first quadrant because an exporter and e-commerce provider does not have the option of other returns or simplified returns. For them, they have to mandatorily fall under RET1, Annex 1 and Annex 2. The only difference is that you can choose a periodicity of quarterly or monthly, but the return form will be same as your large taxpayers. What if I'm not an exporter? In that scenario, the government gives me two options. The first option is RET1, Annex 1 and Annex 2. The second option is I file RET3 instead of RET1. This is the second quadrant on your right hand side topmost. Wherein if I am a B2B, B2C, RCM, exempt and non-GST. So I do not have any exports, but I do have B2B and B2C supplies. For everybody's convenience, B2B means business to business, that means registered taxpayer to registered taxpayer, and B2C means business to consumer, that means to an unregistered taxpayer, unregistered person if a business is supplying to. Moving on to the third quadrant, which is the bottom quadrant on your left hand side. If I do not have any business to business transaction, the government also gives me another option, which is RET2, that is Sahaj return, and I can file this return in a simplified manner. Quarterly periodicity or monthly periodicity is still an option for all three quadrants. And the last quadrant is on the nil turnover. If I am a nil turnover small taxpayer, I do have an option of filing returns through an SMS rather than going through the chaos of the entire portal. So this is something that returns will look like for a small taxpayer. Assuming a small taxpayer opts for a quarterly system of filing, how would the illustrative compliance process look for him? For him, on between Jan to March, on a real-time basis, he will still have to upload invoices. While his customers may not or may be eligible to avail credit of invoices that he keeps uploading by the 10th of the subsequent month, he will be only filing his return by the quarter end, 25 days from the quarter end. So the first step would be he will still have to keep uploading on a real-time basis. He'll finalize his sales liability for Jan 2020 by 20th February. Why would a small taxpayer need to do that is because while the periodicity of return is quarterly, payment of taxes will need to be done on a monthly basis. The third step is that he will also need to simultaneously work on his input tax credit availment. Because even though his return liability is on a quarterly basis, the cash outflow or the tax payment comes out on a monthly basis, and hence he will also have to match his Annex 2 on a monthly basis to see what is put in by the vendors on their system so that he can take a credit. Directly brings us to step 5, which is PMT08 and a monthly form, which is a one-pager form that a quarterly taxpayer will have to file to pay taxes on a monthly basis. When I move to step 6, by 20th of March, I will repeat this steps for the month of February. The only difference would be for the month of March, my steps 7 to 8 will vary. What is 7 to 8? On the 7th step, that is on 10th of April, for the entire quarter, I will be filing the Annex 1. That means finalizing the Annex 1. Or in the 8th step, I will finalize the input credit for the Jan to March quarter. And for the 9th step, I will file the RET1, RET2 or RET3 as I have selected as an option and as I am entitled to by 25th of April. So if you see, for a small taxpayer, exercise of payment and calculation of input tax credit, like Jigar mentioned, will happen on a monthly basis. but finalization of returns will still sit on 10th of April, 17th of April, and 25th of April. Just an overview of all that we have discussed on how a compliance calendar will look like if you are a monthly or a quarterly taxpayer. Dates of 20th, 10th, 17th, like I have highlighted in green specifically to outline that the law does not put in 17th. The GST portal has not put in 17th. This is something that we have worked on a back calculation basis the instructions in the system, that the system will not be available between 18th to 20th. That's why we have arrived at a date of 17th. And lastly, the RET1, RET2, and RET3 for quarterly taxpayers, which is on the 20th of the subsequent month ending quarter and payment on the 20th of the month. How does this new compliance system impact you? Now, assume we have three scenarios. Okay. First scenario is, which is a very nice scenario. The supplier uploaded all your invoices in Annex 1. All the invoices are correctly appearing in your Annex 2. You are faced with two options: either to accept all the invoices and claim the ITC, or to put it on hold for subsequent tax period. This is a business decision that you will take depending on whether you want to avail the credit or no, and also will be required to be seen in accordance with Section 16. Now, Section 16 is nothing but 4 to 5 conditions which outlines your eligibility to avail a particular credit. The second scenario is where is a mid-level complexity that arises. My supplier has uploaded a particular invoice in Annex 1, but he has uploaded the incorrect details. In that scenario, if a person accepts that invoice, or if the recipient accepts that invoice, the supplier's liability is locked on an incorrect invoice. Versus if I reject that invoice, it is sent back to the supplier for amendment. Now this is where the whole cat and mouse chase turns the other way around. In the earlier compliance system, where a recipient had to chase a supplier for availing credit or disclosing his invoice, in this new compliance system, there is a possibility that the supplier may chase the recipient for rejecting a particular invoice. Why is that so? Once you have accepted an incorrect invoice as a recipient, the supplier's tax liability is locked, and at the same time, the supplier's correct customer is not getting that credit. So you are sitting with a credit that you may not be entitled to claim. The supplier is sitting with a tax liability that he has to discharge, and his second customer is sitting with no credit in his books. This creates a challenge for the new customer or the second customer also, and as well as the supplier, because that customer will insist on claiming credit, and that's how the supplier will come back to you to unlock or release the invoice. The most best or the advisable action to take is to reject such invoices rather than lock stock barrel of accepting them. The third scenario is where the supplier does not upload a particular invoice in Annex 1 or does not file. In that scenario, the recipient has an option to provisionally claim the credit and inform the supplier that he has claimed particular credits. Now, this information or informing or communication with the supplier does not need to go on a manual basis. This is something that automatically the GST system will do, because the moment you claim or put these provisional credit invoices in your Annex 1, in your Annex 2, and it will automatically be disclosed to your supplier that these are the particular invoices he needs to work on and show in his returns or file or pay taxes to. If supplier amends this credit or amends these invoices or accepts these invoices, your credit is available to you. But if the supplier does not amend this credit for T+2, that means up to 2 monthly tax periods and up to 1 quarter in case of quarterly filing of return, he does not amend this, a view is that credit will need to be reversed. Why is this view coming out that credit will need to be reversed? Is when you read Section 16, it says that if your supplier has not paid taxes to the government, you shall not be entitled to claim that credit. And also the GST instructions on the new return form allow a grace period for the supplier of 2 monthly periods or 1 quarter period for amending and disclosing invoices on which his recipient has claimed credit on a provisional basis. Reading all these instructions and the law together, there is a possibility that on T+2, if your supplier has still not worked on that invoice, you may have to reverse this credit. I have just put in a quick snapshot of how is the invoice management options going to look like for you when you have to claim a particular credit, or rather when your customer is going to work on particular credits that you disclose as sales to them. There are 6 key actions. The missing action is where you have not uploaded a particular invoice. The recipient will show these invoices on your behalf and you will be required to either accept the liability, and if you don't disclose, then that's something that the GST portal will pursue with you, because your recipient will have to be reversing the credit on this. The second action is on pending invoices, where if there is any ITC that you do not desire to avail at that particular tax period and put it off for the next tax period, you can put it on hold. The third action is on rejection, where, like I mentioned, if there is an incorrect detail, you can reject this. The fourth action is on viewing. The GST new system portal will also allow you to view the invoices on a real-time basis uploaded by your supplier. The fifth one is on locking. So the moment you lock your particular input tax credit, locking will happen with you filing the final RET 1, or as the case may be, whatever return is applicable to you. So you will be locking that particular invoices that you accept in your Annex 2 when you file your RET1. And the last one, and which is the most important one, is a deemed locked action. Now there would be certain invoices on which if you take no action, that means you do not put them in pending, you do not put them in reject, you do not put them in accepted, the system itself will deem lock the invoice the moment you file your RET1 or whichever return is applicable to you. When it deemed locks that particular invoice, that means you will either be able to take credit or show it in your ineligible credits, but the supplier's liability will be freezed to that extent when it is deemed locked. So it is advisable that you at least show some action against these invoices rather than deemed locking, because it's an additional compliance. If the supplier comes back to you tomorrow and says that this was an incorrect invoice shown to you, you will have to go back to your GST returns and unlock or release this invoice in future. Now, what if I have a scenario where taxes are not paid by the supplier and the recipient still wants to claim? He's claimed it on a provisional basis, and still after T+2, the supplier has not shown this invoice in his returns. In that scenario, the consequences are threefold, and all three consequences will have monetary impact in terms of your cash flow statement or your payment of tax liability, because the first step would be for recipient to reverse this credit. The second step would be the supplier will have to either pay taxes or necessary action will be initiated against him by the GST authorities. And the third step would be, if the 2 or 1 month tax grace period for uploading this invoice has lapsed, in that scenario, your interest clock as a recipient will start ticking for not fulfilling Section 16 conditions and availing incorrect credit. So this is something that as a threefold consequences that could occur to a recipient and a supplier if the taxes or the invoices are not correctly uploaded. I will move to now discussing on the components of GST Annex 1, and I will take you through each and every return form, that is Annex 1, Annex 2 and RET1, to tell you which components are those which are similar or which have already been worked upon in the past, and which is the new components that you'll have to be working under your new compliance system. The old ones are, like you can see, URD, net of credit note, debit note, RD supplies, supplies to SEZ is something that you're already working on when you're preparing GSTR1 data. So there's no business change as such or no change as such as an action point for you when you're working on Annex 1 to the extent of this data. But now there are 4 data points on the left hand side of the screen that you will see. RCM of RCM net of credit note, debit note, import of goods, import of services, and missing documents on which you want to provisionally avail input tax credit will be sitting in your Annex 1. So by the 10th of every month, now these are 4 additional data points you will have to collate and start preparing on. What are the keynotes that you need to remember from an Annex 1 perspective is the liability will be in the period in which the invoices accounted for are uploaded, irrespective of the invoice date. So the invoice date impact will be taken up by GST authorities during their scrutinies and assessments, but you will be paying off liability in the month in which you upload this invoice. The Annex 1 format requires a 6-digit HSN code, whereas as on date, the law requires you to put in a 4-digit HSN code. So businesses which have adopted to 4-digit HSN code will now change to 6-digit. Negative values will be allowed. Under the earlier system, they were not allowed. So now you can put in the negative values of credit notes if your credit notes are more than your turnover for that particular month. Advance related adjustments will not be allowed in this Annex 1 form. You will have to put it off to the next period. And the next 3 points, that is 5, 6, and 7, we have already discussed earlier. That is locking and unlocking by the recipient will be done. Editing can only be done by the supplier, and invoices or details uploaded up to the 10th of the following month, if they are not accepted, can be edited by the supplier. Moving on to Annex 2. Now Annex 2 is going to give you details of all your local procurements that you have done from registered people and all those who have uploaded sales against your GSTN. The next 2 data, that is import of goods and ISD credit, is something that that will come in future. So ISD credits is something that you can put up, but import of goods and imports of SEZ is for now sitting in your Annex 1 data, like you would have seen in the earlier slide. I mentioned that you also have to collate import of goods data and put it in your Annex 1. This data in the future, not at this phase, will be coming in automatically from IceGate and the SEZ portal once the system goes live. So for an interim period, the government has said that this is something that you will have to work on, but in future they are trying to link it with customs and SEZ portal to simplify a taxpayer's life. Moving on to the form RET1, almost all the fields will be auto-populated. But does that mean that a taxpayer does not have any work for filing RET1 and it's just a simple or mere bank payment challan that he has to generate? In that scenario, I would like you to refer to these 10 points that I've put up on the screen, that the tax team still has certain manual fields to work upon in RET1. The key fields that you will work upon in which you were already working upon while making your GSTR 3B as on date are your reversal of input tax credits, your bifurcation of capital goods and input services, transition credit from 3B to the new return. So these are some important points that you will have to work upon and manual fields that a taxpayer will need to calculate. Amendments are possible in the new return filing system. Like your earlier system where revision was possible in the subsequent period, amendment is possible in this new return system. Amendment of GST returns will happen through 2 forms, Annex 1A and RET1A. Amendment of tax invoice will happen only to the extent that is not locked by the recipient and through the amendment of a return for the next tax period. 3-4 important points about the amendment returns. These are forms that you will upload and can be revised multiple times. These forms are similar to their predecessors, that is Annex 1 and RET1. Missing details you can upload which have not been uploaded can be corrected through Annex 1A. And lastly, if payment is made, if a liability arises through your amended return, you will have to regenerate a payment challan and make the payment by the next 20th or the date that is coming forward for your next tax period. One important point for small taxpayers here in the new compliance system, if you are opting for Sahaj and Sugam, that is, if you are not an exporter and if you have only B2C supplies, then you are going to file RET3. If you have only B2B and B2C supplies, you are filing RET2. Please remember that you will not be able to claim credit on a provisional basis under RET2 and RET3 option. So if you desire to claim credit on a provisional basis, RET1 is the only option or choice that you're left with, is something that you need to understand. A quick snapshot of what are the changes between the existing versus new return system. The existing system did not require you to bifurcate capital goods, inputs, and input services. The new system requires you to do so. The existing system also had a reconciliation of turnover between GSTR 1 and 3B. The new system, this issue will not arise because whatever you disclose in Annex 1 is going to be used as your final liability in your RET1. ITC, while it was on a self-declaration basis under the existing system, in the new system, it is going to flow through Annex 2. If there is returns pending for filing for deregistration application, every assessee who had not deregistered or who did not receive a cancellation order from the government was still required to file their returns. In the new system, his registration number would be suspended and these new returns will not be required to be filed by him. Some open points which have already been covered above, but just to help you put a perspective and consolidate them, 4-digit to 6-digit HSN coding will have to change. Composite dealers will are still, clarity on their returns are still awaited, and tax amount will be calculated by the system, but you also have an option to report the cess amount on your own. Moving on to what was the transition plan of the government when they released a press release in June 2019. They plan to go live by Jan 2020. If you see how the phased manner implementation was going to happen, wherein in July the sample system was going to be available to us, October to December, that is the quarter that we are in presently, we were going to migrate to Annex 1 instead of filing GSTR 1 for large taxpayers. And Jan 2020 was going to be the first month where old returns would have phased out and the new returns would have come into play. But since we are in December, I would just like to highlight that presently not many taxpayers are uploading their Annex 1. While the utility is available on the portal, since taxpayers are not using this facility and it is optional, you are not able to view as a recipient Annex 2, that is your credit availability, because of which RET1 is not auto-populated, and April 2020 as an implementation date for new compliance system seems more realistic than Jan 2020. Just 2 points here I would like to add over the and above the transition point. Variety of our taxpayers or our clients are receiving calls from the government authorities insisting them to file Annex 1 and Annex 2 for this tax period. If you are one of them, you may seek to oblige or not. That's a call that you will have to take. But it is advisable that you start working on or start preparing yourself to file Annex 1 very soon. Because while the government authorities are calling for or you to use this option, very soon this option will be mandatory. Top thing for the companies to do to comply or migrate to the new compliance system is, one, you will have to revise your compliance SOP, because now and on every 10th, 17th and 20th of the month you will be working on the data points for payment of taxes. Your cash flow management will need to be revised, because you are today as on date claiming 120% of your eligible and matched credit, but in future you will have to regulate this provisional credit, otherwise interest implications could occur after 2 tax periods. A transition management plan is imperative, because you're moving from an old compliance system to new. So invoices that are missed out, invoices on which credit is not available, how do you want to claim it in the new system, and what is the cutoff date when you move to the new system is something you will have to set in. While in the earlier return system and when GST came into play, we were talking about vendor contract revision and tax liabilities or indemnities from vendors. In this new compliance system, you will also have to talk about customer contracts, because now if your customers lock in your incorrect invoices, you are faced with a double challenge. One is paying taxes on an incorrect invoice, and second, disclosing the correct invoice so that your actual customer receives this credit. So how you want to revisit the tax clauses in customer contracts is also something that you'll have to see. Vendor onus is something that has been carried forward from the previous processes only, but you will have to revisit the commercial terms with vendors, because now the reconciliation will happen on a real time basis and not on an annual basis. Training and communication, the need for all transitions, training of employees, and adequate communication to customers and vendors is inevitable at this point and should be started off as soon as possible. So this is the gist and summary of the major discussion of today's webinar, which is the GST compliance. I will now move to the next section of the training, which is on e-invoicing. And if you have any questions on the new compliance, you may put it up right now in your chat box, and we will take it up at the end of this webinar. Moving on to e-invoicing, and I will pass on the mic to Jigar for throwing his inputs on the new e-invoicing system.
So, okay, thanks. On e-invoicing, I think this is a concept which has been introduced uh, by the Indian authorities, and following the global mechanism. If we see the data, most of the countries, or rather many countries, have introduced such kind of concepts earlier globally, and India is also willing to, rather wishing to get into this zone of ensuring that e-invoices are raised. This concept is very new, and what we are doing at this stage is only bringing up 30,000 feet information to you on how things are being planned, so that we all are ready to work upon it, and ensure that we are aware about it at this stage. So what is e-invoicing is a simple concept where you are raising your invoice. Today everything remains as is, business as usual, but your invoices will be raised, and information about that invoice will also be given to the government, and government will in return give you a number, a unique number, which would be used by you to put on the invoice itself. So what is happening here essentially is, government will get the information about your sales and your customers' purchases at the level which is not at the returns level, it is at the level where you're raising your invoice. So there comes the big change, is where we raise our invoice, we put it in our system, in our accounting packages, in our ERPs, and then we consolidate the information by throwing the data and filing the returns with the government, versus what we just discussed earlier is auto population in the returns that will come in through the information which government is already possessing, and the government will possess that information through this concept of e-invoice. So that's the way the concept is, wherein you will have to raise your invoice only after getting an IRN number from the government, and probably the next slide will explain you in a better manner. But before the next slide, I also would like to highlight that the government is proposing on a voluntary basis to seek support from the industry to get into the e-invoicing modules from January 20 onwards, which is just 20 days away from now, for companies who are crossing 500 crore annual turnover. And also they're attempting to make it mandatory for a certain class of SSEs by April 20. While the ambition is huge, if even if the dates are not met, it is going to see the reality very soon, is what we feel. The next slide will explain you basically what are we trying to talk on e-invoice, and then we'll move on to the topics and the Q&As. So what is happening is, you will raise a regular invoice, or rather you will prepare a regular invoice using your current ERPs, or current way you are preparing your invoice. That data will have to be uploaded onto a portal which is called an invoice registration portal, IRP portal. uh, we have to remember, this is, whilst it's a government regulated portal, it is not the GST or GSTN which we are talking about. This is an IRP portal, only portal which is prepared to give you back the IRN number, which you will put it up on your invoice. So the key lies on the aspect that when you are raising the invoice before from proforma invoice to the final invoice, the journey will also include your information going to the government and government giving you a IRP number, IRN number back from IRP, and that IRN number will be then put it up on your invoice, and then it becomes an e-invoice for you. Now, you will also be willing to understand that what is IRP and how will it really help me from GST perspective. Then again, that's the government's thinking pattern on where IRP will talk to GSTN and pass on all the information about your sales to the GSTN network, and GSTN network will pick up your information and keep storing that information for you to get your auto-populated returns back. So that's the thought process behind it. If you see the steps, I will not go in deep in here, but the intent is to get an IRN number from the government before you generate your invoice, and get passing on the information about your raising of invoices to the government. Yes, there would be multiple uh, you know uh, uh, data points and multiple questions that one may start having once we enter this zone of how do we really cancel the invoice, what do we do with amendment of invoice of data, do we raise a debit note, credit note, is it a main a procedural very cumbersome process, etc. Time will say whether things will fall in place, because what we are talking about is Indian economy as a large economy to get covered on the e-invoice platform, and data to go into this modules on an ab initio level. Um, and hence probably the government is looking at only capturing first large taxpayers into this net, and then gradually getting into the mid-size and small size as well. Earlier the thought was even e-way bill may not be required once we have this e-invoice in place, but yes, what we are listening recently is where even e-way bill would be required, e-way bill number would be required along with e-invoice, because till the time e-invoice is completely geared up and settled, the movement of goods and the e-way bill has to be done appropriately. Hence, e-way bill and e-invoice will go parallel in my view, and we'll have to be more compliant from this perspective. So, Rebecca, why don't you just give a brief overview of the slide, this one and the next one, and then move on to the audit bit.
Yes. Uh, E-invoicing features, Jigar mentioned that there's something known as IRN that will appear on your invoice. What is an IRN? Clearly, it will be made up of three details, that is your supplier's GSTN, supplier's invoice number, and financial year. And it would be a hash form of encryption that would be based on an algorithm, and that number will come up to you. IRN is a mandatory field to be present on each valid invoice. That means going forward, if you are applicable for e-invoice, only that invoice would be considered valid which has an IRN generated towards it. There is a central registry which will store all this information, because the IRP will be using this registry for checking duplicate entries or duplicate invoices. Your accounting and billing system will have to incorporate this feature of IRN. So whatever it mandates, to that extent, ERPs we may need to see a reworking. The next feature is on IRP, like Jigar mentioned, and if I have to compare it to, it's akin to something known as your GSP, how different GSP vendors got licenses to work or use them as a conduit to finally put your data on the GST portal. IRP is also going to be a similar person who's going to be licensed by the government and whose portal you will be using to generate your invoice number or IRN. He will validate the authenticity of the information that you've done, duplication checks, digitally sign your invoice. He will transmit, or this IRP will transmit your data to the GST system and e-way bill portal, slowly phasing out the requirement for e-way bill. This e-invoice which is finally generated will be automatically emailed by the IRP to the registered or the invoice email ID that you mention on the invoice, and there will be multiple IRPs that will be present, like how you have multiple GSPs present or GST Suvidha providers present as on date. You will have multiple IRPs to partner with, and that's a business decision that will come up to be taken. The QR code is something that is another feature along with the IRN for an additional security that has been added on this invoice feature. It will contain 7 details, and a combination of all these 7 details will generate your QR code. It will be in printable format and will be required to be put on your invoice that you generate. Some key facts on the new e-invoicing system is invoice will be still generated by your accounting or ERP software. It is not going to be generated by your GSTN portal. GST portal will only give you validity checks, that is the IRN and the QR code for making your invoice valid. The timeline for generating an e-invoice or that e-invoice will be available on the IRP for your extraction for 24 hours, after which it will not be available for you for viewing. Invoice contents would be all mandatory fields would need to be provided. Amendment of cancellation of this e-invoice is going to be allowed only on a full basis, not on a partial basis. So 1 or 2 incorrect details will mandate an entire cancellation of invoice. Bulk invoice upload facility has still not been updated as on date, or there is no communication from the government on this front. But because e-way bills and utilities, offline utilities allowed this facility, you could see something like this being explored in future. What are the modes of generating e-invoices? 6 modes, either through a web-based application, an API-based application, SMS-based system. There will be a mobile app. An offline tool would also be available to you, and also be linking it with the GSP or the GST Suvidha provider that is there. So 6 modes, any of the 6 modes that can be used by a particular taxpayer who is mandated to generate an e-invoice. The objective of implementing this system was very clearly communicated by the government in their brochures and FAQs. It is mainly to curb tax evasion, help in audit and scrutiny. It will reduce, impacts of reconciliation and standardization of invoices across industries. So helps the government with a lot of convenience when it comes to reviewing or assessing your files. Similar to your change in compliances, what is the change or actions that you need to do as a company to implement new invoice or e-invoicing system? Is this invoice process change will now we have to implement it in your SOPs. The new generation process, that is, you will have to link in the IRP or the IRN with your ERP, is something that you have to mandate. Business evaluation will need to be done at a transaction level, that how would you or sales team provide the data to your tax team to communicate finally with an IRP, get that back to your accounting, and what is the business case that you want to put up. ERP is certainly going to see a change, because today's fields of invoices that ERP generates, any of the ERPs available, do not have an IRN. While most of the top ERP providers are amending their invoices or putting up a new patch for IRN facility, you will have to see which ERP you are working on and whether that patch is available to you. Training and communication, again, a key or crux for any change. Appropriate trainings to your employees, and customer and vendor communication will need to be undertaken. If you are expecting your vendor to follow an e-invoicing system and he is not following it appropriately, the credit on such invoices will not be available to you if it's not a valid e-invoice that is generated by him. So this is the sum and substance of e-invoicing. I will move changes on annual returns. Annual returns. The annual returns changes are a few. When you see the table 4, which is your details of all your output supplies that you had to provide, the option is given to provide these net of debit notes, credit notes. That means you may not disclose the credit note and debit note separately under IJKL, that is there in table 4. Similar to table 4, table 5 has also seen an amendment. Exempted nil and non-GST supplies can be clubbed. There is no need to split it. Why is this helpful? Is because now you do not have to categorize or decide what was exempted under the GST law and what is a non-GST supply and what would qualify as a nil rated. You can consolidate and show them under exempt. Your credit notes or debit notes amendments can now be shown on a consolidated basis in the earlier cells instead of separate disclosure. With respect to your input tax credit, the bigger challenge was on dividing inputs, input services, and capital goods of all the ITC availed, because under the earlier compliance system, that is GSTR 1 and 3B, this division was not mandated and hence companies were not following it. Now, under the revised or the amended form for FY 18-19, you may need not have to split this up. You can just show it as a consolidated amount under inputs. This is on the reversal calculation of input tax credit. All the reversals, that is 37, 39, 42 and 43, namely on your exempted turnover and your partial credits that are available, need not be split under every rule and provision. You can show a consolidated reversal under column H1, which is other reversals, instead of splitting them up between A, B, C, D. And the only change is F and G, that is Tran 1 credit and Tran 2 credit, will have to be mandatorily reported. Lastly, in table 8, A, the auto population will happen as on 1st of November of GSTR 2A, and the reconciliation between audit form, this reconciliation between GSTR 2A could be directly submitted in GST audit rather than disclosing it here in a PDF format. Certain other fields that have been made optional, similar to your composition supply, deemed supply, goods sent on approval, HSN-wise summary for outward and inward tables, all these fields have been made optional under the new annual returns. Moving on to your GST audit amendments. As you are aware, GST audit has 5 parts and 2 types of certification. The major changes are in part 2, part 4 and the certification. I will take you through each of the changes very quickly. If you see in table 5, where you are disclosing your financial turnover with your GST turnover and reconciling them on accounts of various heads. For example, in table 5, F, you will see trade discounts accounted for in audited financial statements but are not permissible under GST. You had to add this to your financial turnover. Now, all this bifurcation is not required by the authorities or has been made optional by the authorities, and a consolidated adjustment entry can be passed on in column 5O, which is all the plus and minus, the net effect can be given in O. The only challenge here would be not from an assessee perspective who makes this form, would be from an auditor perspective. How is he going to validate these reasons, and what are the questions he will ask you to validate this disclosure in table 5O is something that you'll have to see for 18-19. In the table 12, there was an option to not disclose in column B and C the financially earlier claimed credit in current financial year, and likewise vice versa. This can be shown as a consolidated unreconciled amount, but this unreconciled amount will still have to be bifurcated in reasons under table 13. So while this is not a major change in terms of splitting up the numbers, but the reconciliation reasons will still need to be worked upon. Part 4, this was a major challenge for all assessees to split their input tax credit into purchase heads. This has now been made optional by the government to not fill it for FY 17-18 and 18-19. Most of you would have filled 17-18. You may not be allowed to go back to amend and correct those disclosures, but you can use this benefit for the financial year 18-19. And lastly, the certification change in GST audit is, instead of using the words true and correct, which was a more stricter term of certification, the authorities have changed it to true and fair. That means sample based checked by GST auditor could now see a process change in asking information. And the second one is on cash flow statement. Cash flow statement was one of the mandatory things that was required to be mentioned in the GST audit certificate, that your auditor has reviewed this cash flow statement. Now, under the new audit form, the certification will put this as an option that cash flow statement can only be reviewed by auditor where it was mandated for you to prepare it under any other statute. You need not prepare it separately for the purpose of GST audit only. This is on annual returns and audit and marks the end of my or our presentation on the new compliance changes. We covered four aspects, ladies and gentlemen, on the new compliance process, e-invoicing, annual returns, and GST audit forms. If you have any questions, you may please put them on the chat box. We are taking up questions from the chat box right now. Invoices are uploaded prior to new returns, but the credit to be claimed post implementation of new returns. Does it require user to manually input the data? Yes, this data will need to be manually be inputted in RET1 under table 4A.4. Bulk upload entry can be expected in future. Right now, there is no clarity on bulk upload entries for those invoices that were pertaining to prior period or before starting of new compliance. The second question is, do we still need to manually sign invoices in the e-invoicing regime? No, manual signing of invoices may now be done away with for those people who e-invoicing will be mandatory for. Another question that we have is is on Annex 1 and Annex 2. Will it be completely auto-filled? So, ladies and gentlemen, Annex 1 is something that you will have to manually upload. Annex 1 is not going to be auto-filled. Annex 1 is your base annexure that will be used for filing or determining your tax liability in RET1. Annex 2 will be something that will have been auto-filled to some extent, and some fields may have to be put in by you. Why would it be auto-filled? Because this is something that your supplier would have shown as a sales to you, and that credit would be disclosed in Annex 2. The next question, again related to e-invoicing, whether multiple debit or credit notes can be issued against a particular e-invoice. Yes, you will be allowed to link multiple credit notes or debit notes against a particular e-invoice. As on date, that's how the system would work. We will have to see. While under the earlier system, also we were committed or we were told that a consolidated credit note, debit note could be uploaded against a single invoice in the GST portal. The law has been amended to that extent, but the facility was not put up by the GST portal. You'll have to see how technology supports in respect of this schema. Whether exporters would also be required to generate e-invoice or to undertake e-invoice compliance. Yes, it is mandatory for exporters to also undertake e-invoice compliance if they are crossing the mandatory threshold limit. One question we have on annual return and audit form, whether you can avail already availed benefit in 9 and 9C, the amendment benefits that are coming up. Sorry to say, already filed returns will not be able to utilize this amendment benefit. The new annual returns and audit forms that you'll be filing for the next financial year is something that you can explore these optional benefits in.
I think we have few questions. What we'll do is we'll take down these questions. We have your email IDs as well. We'll write back to you with the answers, and probably we may set up a call in case we are not able to understand the question.
Thank you, Jigar and Rebecca, for taking out the time to share your valuable insights with us. We would also like to thank USISPF for their support. In case you have any other questions, you can write to us or to Shweta. We will be happy to address them. We hope that the insights shared by our speakers have been useful for all of our listeners. Thank you once again, everyone, for joining in.